But if your income on a $5 million property is, let's say, $250,000 of net operating income, so you're left with a hole of how much tax you still have to pay. Now, don't get me wrong, getting $120,000 of tax deductions right off the bat is great. Okay, you don't have almost anything else like that, but you still have that tax liability. So cost segregation comes in and allows you to take accelerated depreciation. So it allows you to identify things through an engineer in the building that actually depreciate faster, meaning you can take those tax deductions at a faster rate, allowing you to take more depreciation deductions earlier on. So in the first 5 years of ownership, you'll be likely not paying any income tax because you have so many tax deductions. So that's in a nutshell how cost segregation works. So in a regular depreciation, you would have $120,000, $250,000 of income, 20% of the building, of the $4 million building, 20% of that you can take as an extra write-off in the first 5 years. So 20% of $400,000, approximately $800,000, right? You can take that as a tax write-off, an extra $200,000 a year, or $180,000 approximately a year for those next 5 years, essentially wiping out your tax liability.
And how does that trickle down to passive investors?
Yeah, excellent question. When you invest in a property passively, you are going to get both the returns on investment and you're going to get the tax benefits that come along with that. However, you are limited to how much of those tax benefits you can actually realize, because how depreciation works is it is first and foremost only used to offset passive income. So passive income is considered the income from your properties. And if you're invested in a number of properties, that depreciation deduction can then be used to offset any of the income from any of those properties. First and foremost from the property that income comes from, that deduction comes from. So you may have let's say you invested $100,000, okay, into a passive investment, and you're getting an 8% return. That 8% return will give you an $8,000 income statement, and you'll get a tax form that's called a K-1 form, which will show not only your income, but will also show expenses. And depreciation is one of those expenses that shows up there.